Hi everyone, welcome to the Fund Finance series. I'm Mbayi, Head of Bank and Finance of the Luxembourg full-service law firm Praxio. The Fund Finance series, you know the formula. I gather with experts in the industry and we discuss about the specific topic. The topic of the day is market update and due diligence. And to discuss this topic, I have a great panel today. So we have Leah Edelboim. Hi Leah.
Hello, thanks for having me.
Pleasure. Can you please further introduce yourself, Leah?
Sure, I'm a fund finance partner at Cadwalader in New York.
Thank you. We have also Agustin Saez. Agustin.
Hello, nice to meet you all. 15 years within Banco Santander, mostly within the structured finance arena, project finance, LBO, real estate, and during the last 8 years, launching our fund finance franchise.
Thank you, Agustin. You have Russell Evans. Hi, Russell.
Thanks, Michael. Yes, so I head up the funds finance coverage at National Australia Bank. Circa 20 years in fund financing at Lloyd's and at NAB. Thanks for the invitation.
Our pleasure, Russell. And you have Cam Roper. Hi, Cam.
Hi, Michael. I'm Cameron Roper. I'm a partner at Weiss, specializing in fund finance, based in London. It's great to be here today.
Thank you, Cam. Russell, to kick off, can you maybe tell us a bit more about why fund finance is becoming more and more popular for private equity funds?
Yeah, I know. I sort of caveat that these are all kind of personal views, but observations really that we are looking at longer asset hold periods. So we are looking at sort of slightly more uncertain economic times. It is taking longer to fundraise, and there is a lot more pressure on the return of capital to LPs. So the so what to those three is that GPs are typically looking at ways they can lean into that using effectively traditional subscription lines and also hybrid and NAV financings, just to relieve some of that pressure and recycle that capital and make those distributions back to LPs. That's my 2 pennies worth, Michael. I'll open it up to the rest of the panel to comment.
Thank you very much, Russell. And Agustin, what are your views on that?
Okay, so stating the obvious and taking into account that fund finance is an unbeatable tool to manage liquidity and obtain flexibility, I want to bring some attention to a couple of situations that we are seeing in the market right now. The first of all is, for instance, we are seeing more and more funds using ECL-backed loans, meaning that, for instance, when they need to top up some debt and the subscription line is already used for another transaction, or they have a clean down restriction, what we are seeing in the market is that in order to provide liquidity to some portfolio companies, the funds are issuing ECLs in favor of the banks. So you are somehow a senior unsecured creditor of the fund. Obviously, there is a prime over the subscription line, but this prime is still accretive compared to the IRR that the fund is showing to the LPs. So we are seeing more and more those situations as another tool in order to raise liquidity. And I mean, on top of the subscription lines, the hybrid, the NAVs, the recap, the current constraints right now we have in the market, this is at least my 2 pennies contribution to the, to the current market trends we are seeing in the market.
Thank you very much, Agustin. And Leah, what common misconception about fund finance would like to dispel?
That is fun. No, just kidding. So I think that right now there's a lot of focus in the media about the use of NAV financing predominantly to return capital to investors. And by and large, while some facilities do indeed contemplate that as a use of proceeds, really it's more use of a loan for working capital and other purposes, and in the vast majority of cases.
Thank you very much, Leah. And Cam, from your side, would like to add something?
I think that, there's probably not a perception amongst the people on this panel, but I think, some people in the market might think that it's still quite a sort of commoditized product that doesn't take sort of much negotiation. It's just a sort of box ticking exercise. And, while that might have been true maybe a decade or 15 years ago, today I think that really you're seeing some really innovative products in fund finance. You're seeing not just the use of sublines and NAV facilities, but you're seeing GPs look to finance their GP commitments to their funds. You're looking at sort of the intersection of securitization and fund finance as a methodology to raise capital. So there's really just a whole range of different things. And, even a subline, which, a lot of us have worked on a lot of those before, there's still key points that need to be negotiated on every deal. It's really not sort of that sort of commoditized product that I think some people might have in their head if they think of just a pure sort of subline type of facility.
I just want to respond to that. I totally agree. I think that even if you're doing a down the middle of the fairway subline, we're seeing greater complexity in the underlying fund documents. We're seeing series structures, we're seeing evergreen structures, we're seeing all sorts of, innovative ways that a fund is looking to bring investors to the table and raise capital in a difficult fundraising environment. And I think that the other thing that we're seeing is, given greater complexity in fund structure and some other financings that a fund may have, we're seeing other elements of other types of products that are coming into subline. So it's a subline plus a share pledge. It's a subline that, has some hybrid features, even from the very beginning. So, the commoditized subline, I don't think I've seen a plain vanilla subline in a long time.
Thank you, Leah. Thank you, Cam. Indeed, I agree with you that fund finance transactions are quite bespoke, even for subline. So you still need lawyer for this. You cannot close with an AI. So I think that we still have some work to do with in the coming years, hopefully. And Agustin, regular GPs coming to you for fund financing solution, what are the key considerations to be tackled by the GPs?
So stating the obvious, and you believe me, so the first thing they need to know if they can incur in indebtedness according to the LPA, okay? Because sometimes we have been negotiated a couple of weeks with an asset manager, and suddenly they realize that they are using an LP mirroring the previous vintage, for which they had some restriction in terms of indebtedness. And suddenly, either they need to change the LPA or we cannot go ahead with this particular transaction. So it's not a joke, it's real. We have experienced it not once, not twice, so more times. So this is the first one. When you know that you can incur in financial indebtedness, how it works, the overcall limitation in the fund, if the LPs can make up not honoring LPs, if they can provide the pledge over the uncalled commitments, all the things with the notification to the LPs. And leaving aside the typical things you are used to see, what it is important for us, at least when we discuss with the GPs right now, is the ability to rate the transaction and the ability to use private credit insurance and the ability to rotate. So 1 year ago, 2 years ago, it was almost impossible to rotate the subscription lines or the NIVs due to the reluctancy of the GPs in order to somehow sell part of the exposure and share information about the LPs. Right now, with most of the banks full of lines and with the regulator analyzing the models of the European banks, I think that more and more the rotation and the capabilities to share information according to the facility agreement are going to be key. And the GPs should be really aware of this fact.
Thank you, Agustin.
Yeah, I think the bankability of an LPA is really paramount, and it really goes back to that the idea of sort of complexity that you see. We're a lender side practice, and so the very first thing we're going to do when one of our bank clients is looking at, speaking of diligence, the very first thing we're going to do when a client is considering whether to send a term sheet and get into to a deal with a fund is they're going to send us the LPA, and we're going to do an extensive deep dive into it and send them a diligence product, looking at all those features that he's mentioning to make the deal bankable. We're looking at things like, can they pledge, security? Can they, what are the overcall limitations? Is there a waiver of defenses? We're looking at those really fundamental pieces. And if that fundamental, set of criteria is not in the LPA, either the parties are going to go back to the table, or sometimes the fund's going to go away and kind of think about whether it has appetite to make those changes in the LPA to make it bankable, or we think about other solutions for bankability, which may be investor letters and other approaches.
Leah, from your side.
Yeah, I think that maybe just to add to that, and obviously the GPs face this sort of balancing act of to raise more funds, you have to have ever increasing complexities on sleeves and feeder vehicles, and those are that contributes to additional complexity in terms of trying to secure financing against the overall fund. So I think that's one thing to and as we sort of said around evergreen and sort of continue series will mean that it's more important to actually consider your legal counsel. So this is a lender comment, is that we find it incredibly frustrating dealing with GPs who have inexperienced borrower counsel. And trying to reconstruct or deconstruct comments from on a complex subline or even a hybrid is made much more difficult when GP counsel is not as astute to some of the issues. So that would be one of my main kind of considerations. I think then back to basics, the things around investor transfers, that's always going to be a key consideration for any so for any bank that's lending against those investor commitments. Side letter provisions, that's that absolute classic, and that probably leans into really just a consideration that and Agustin touched on this, is that I think GPs are going to have to get used to being a little bit more transparent because there is now, effectively a shift towards non-lender participations or non-traditional lender participations in the market, and there is going to be more and more request for that transparency and the ability to disclose details to either third-party external credit rating agencies, or even the ability to disclose certain level of information to non-bank lenders who may be providing funding or kind of participations behind the scenes or as part of those facilities. So quite a few considerations, I think, in terms of what a GP may have considered a year or two ago versus where we are today.
I was just going to say, Russell, if you ever want to send any of your fund manager clients my way, I'm happy to be GP counsel for them. But jokes aside, I think that one of the things that we often find is a bit of a tension is when we have previous LPAs which are not well drafted but have been used on previous vintages, and the request from the fund manager is to keep the red line as minimal as possible, right? And so it is a real challenge because we understand as sponsor counsel that we need to make the LPA bankable, but at the same time we are sort of walking a bit of a tightrope with what investors will expect to see and sort of the amount of changes we can sort of socialize with them as part of any particular fundraising process. And so I'm not saying that's all the sort of the sort of issues you're encountering or as a result of that, but it may just be something that people have tried to sort of walk a bit of a fine line there. And then I think I just pick up as well with some of the other comments about sort of the transparency, particularly if we're talking about sort of NAV facilities and, you've had the ILPA guidance around best practice on NAV facilities. Even if the LPA doesn't necessarily require LP consent or consultation, then before, fund managers are actually thinking about NAV facilities, it is probably relevant to think about how investors will view those. I've heard of some processes where a effectively, that there's been a long negotiation process with a lender, and then the investors have been approached, not necessarily for consent, but even just to consult, and the investors haven't been happy with that, and it's also sort of effectively ended the process. So just some things to think about.
I just want to echo from the lender's side of a transaction that it makes a huge difference in the way the transaction goes, being across from a team like Cameron's that are super well versed and experienced in the space. You end up with a better deal where everybody's happier because people are looking at the issues that really matter. The deal is a lot more efficient because everybody kind of knows the dance of how you bring a deal from initiation to the closing. And I think that, as much as fund finance is a really attractive practice area and every law firm kind of wants to get into it, as there's been a flight to quality for investors, investing in funds that are of a certain stature, when those funds are using the top flight law firms, you really do get a better deal.
Thank you, Leah. And Russell, what are the current market trends?
Okay, this is a real doozy. So I guess it links back to the environment we're facing into, and actually, there is a level of liquidity that's being driven by demand. So you've got a number of lenders and non-bank lenders in the market, and that's really allowing GPs to flex a little bit in terms of the terms and conditions that they're looking for. The most prevalent of those is around tenor. So we are seeing a majority of facilities now, which were traditionally 1 or 2 year revolvers, being stretched to 3 years. And unfortunately, the pricing still looks like it used to look on the 1 and 2 year levels. And banks are having to hold that little bit of additional capital for 3 years. So that is some way being offset by the banks seeking participations and sort of spreading of that risk behind the scenes, and also, I guess, the involvement of credit rating agencies, etc. So that's the first trend, I would say, is certainly around tenor. The second one is linked really to, I guess, fund financing being used later into the life of funds, and that is where the challenge to both legal counsel, to GPs and to lenders is structuring something that actually has longevity and can really last into the sort of the final realization and sunset sort of phase of the fund life, and provide sufficient liquidity, etc., without having to kind of rely on recallable capital or any other means of liquidity. So late life funds, and then that sort of blends into NAV and hybrid trend. Third one I'd say is interesting, and I'd welcome comments from the panel on this, is that we're seeing a little bit more convergence between Europe and US terms. So there was always a very I guess it was a very bifurcated market. US terms looked quite different to European. European facilities were largely, and continental Europe, I'd say, is largely relationship led, and we often saw some very kind of interesting terms that wouldn't have necessarily been considered market in the US. But now you see Europe coming into line with the US, and also the US terms and pricing coming closer to those available in Europe. So a bit of convergence. And then the final kind of observation, I think, in terms of where we're going in the market is certainly, and it's a challenge to lenders, and that is I guess the search for new sources of fundraising is leading to a lot more high net worths being present in fund structures, and whether they're coming through feeder vehicles or directly. And that does cause certain challenges to the, I guess, the credit process, credit rating, and appetite for traditional fund financing structures. So okay, there's four, and I guess I'll open that up to the panel for their views.
Totally agree, if I may, with Russell. In our experience 1 year ago, or 1 year and a half ago, maybe the pricing for a typical US and European deal was 225 margin for 1 year transaction in the US and 180 for one transaction in Europe. I'm speaking about the tier one asset managers. Right now is the same pricing, so it's 180 both for the US and for Europe, but now for 3 years tenor. And you need to swallow, because somehow our relationship-driven lines, and you get the ancillary business through the M&A, the hedging, the debt advisory. So this is right now the market, with the Asian banks entering and lowering the pricings, with the non-bank new, I would say, players lowering also the margins. So they are pushing down the margins, a lot of demands for the offer. This is one. We are seeing more and more continuation funds with NIB facilities opportunities, because it is true that the interest rates are decreasing, but it is counter net somehow by the tariffs of Trump. So I would say that there is no M&A activity, or we are running out of the expected M&A activity. So we are seeing funds creating continuation funds in order to allocate one specific asset, which is either performing really well or either performing really bad, because they cannot sell it. Also, what we are seeing in the market, and mirroring what Russell has commented, is funds in which you only have high net worth individuals as an LP, okay? 1 year, 2 years ago, it was a no-go on our side. Now we are trying to find solutions. So sometimes what you are asking is, okay, I can give you the subscription line, for instance, if you have already deployed 20%, 25% of the fund, and you already have a skin in the game. At the same time, you are asking them some NIB covenants. So you are looking up, you are looking down, and this is the way to channelize somehow the investment with the high net worth individuals, which I would say 2 years ago, it was almost impossible. Securitization, we are seeing more SRTs in the market. We are seeing also, I would say, more banks trying to scale down because they are full of lines. There is a revision by the regulator in Europe. So the model, the advanced model, is at stake. So there are a lot of banks who are afraid of being trespassed into the standard model, which is consuming 100% RWAs. So they are trying to create SRTs. They are trying to sell funded participation. They are trying to make secondary sales. This is what we are seeing right now.
Thank you, Agustin. And Cam, from your side, what do you see?
Yeah, so touching on, I think, a point Russell made, and also the sort of point about the sort of complexity. We're seeing some interesting things in the subline space, particularly like later in life for funds. And so like a couple of examples of that are, we've seen a lot of fund managers that might have, effectively ended the investment period, but they still have a large amount of recallable capital left. And so we've seen sort of facilities that almost blend the line between sort of NAV and capital call lines. Effectively, they're still capital call lines in the sense that they're secured effectively based on the undrawn, but it's really just the recallable part of that undrawn that's the sort of security for that facility. And the facility is instead being used for NAV-like purposes, so for additional investment in the portfolio on a longer term basis. And so that's sort of one area where, we've seen some interesting products that the lenders have been able to provide, which effectively sort of merge some of the sort of technologies between sublines and NAV facilities. And then the other, which is, again, sort of trying to squeeze excess capacity out of a subline, is sort of the tranche B or second lien subline facilities. So effectively, as you get sort of later into the fund life, because of the advance rates and potentially concentration limits which apply under a normal subline, you're going to find that the fund is sort of capped out on the amount that it can borrow, and there's sort of a shortfall between what it can borrow under the LPA and what the actual facility agreement will allow you to borrow. And so we've sort of seen these second lien lenders who effectively sort of bridge that shortfall by providing an additionally higher advance rate effectively. And they sort of charge higher pricing for that, but also effectively rank behind the initial subline lenders or the original subline lenders in terms of any enforcement process. And so that's also, I think, been another sort of piece of relatively new technology that we're seeing more widely adopted as fund managers explore the use of sublines, perhaps as an alternative to NAV later in life for those funds.
Yeah, I would echo the same thing, that we're seeing a lot of creativity in the subline. I mean, really late in life where you're completely, even in the wind down stage of the fund, using recallable capital for basically the entirety of the borrowing base in the subline. Tons of tranche B coming into our deals. And Cameron, I imagine that these are a lot of deals that our firms are, on each side of those deals. And then, of course, we're seeing, term loan tranches put into deals as well, with oftentimes the tenor of the term loan being much longer than the tenor of the revolver.
Thank you very much, Leah. And Cam, do you see that the current macroeconomic situation has impacted fund finance?
Yeah, I mean, I think, people like Agustin has touched upon the sort of like sluggish M&A activity. I mean, I think you're still in this scenario where market conditions haven't really been optimal for a few years, and we now sort of continue with, increasing economic uncertainty and geopolitical risks. And that sort of backdrop, I think, does mean that there is an impact on fund finance in a couple of ways. Well, there's probably a lot of ways, but a couple that I'll sort of mention. One is obviously that, the exit environment being sort of not optimal means that fund managers are holding on to their assets for longer, and that is, an ideal scenario to sort of facilitate additional NAV facilities, whether for sort of additional sort of capital injected into those assets or for sort of defensive purposes, perhaps refinancing portfolio company level debt that is, about to hit that sort of, maturity date. And so I think that sort of has been a flow-on effect of the macroeconomic conditions. And as more and more fund managers are sort of using NAV, that has also sort of proven the test case for NAV, I think. And so, even if conditions, I think, were to improve, you would still have that sort of base of fund managers who understand that NAV is an additional sort of tool in their liquidity toolkit that they can use as and when necessary. And the other thing I would say is that, is based on the same sort of conditions, you do have fund managers that are coming back to market to raise their new funds, but they don't have the distributions that have been produced from exits because of those sort of slower exits. And that has sort of meant that they have to search for potentially new ways to fund their GP commitments to their new funds. And that's another way that fund finance, I think, can really help, because we see that product really evolving from what was, subline lenders providing GP facilities on a relationship basis to really sort of, new credit fund lenders coming in to provide, much bigger facilities, potentially across multiple vintages, to support GP commitments, but also sort of provide working capital to managers. So really, I guess that, summary is that those conditions, I think, have meant that fund finance has had to find new ways to be innovative. And that certainly is the stuff that's coming across my desk at the moment.
Thanks, Cam. And Agustin, what is your perspective?
Yes, I mean, on top of what Cameron has mentioned, one way we are seeing in the market to be innovative with the current environment are the bridge to fundraising. We are seeing more and more funds who are raising whatever vintage, and they want to buy a seed asset, which is going to attract the first closing of the LPs, but they need to use it as a sweetener in order to attract some liquidity. So we are able, and I assume that other banks are able, to lend against this asset. You have the pledge over the shares over these assets. The fund is already established, but they haven't gone with the first closing. They acquire the asset and they use it in order to attract the first closing. We normally provide a 12 months facility, short term, and we help them in order to somehow raise the new fund, even if they haven't closed the previous one. But it's a way to attract some interest for new LPs, which otherwise they weren't interested in entering in those facilities. This is one. And the second that we have mentioned on the previous question is all the Basel IV regulation and the current, I would say, revision or assessment that the European regulator is making to all the advanced and the standard models, which with the final outcome, it could somehow lead to the banks to rate all the facilities or have more strength in terms of somehow scaling back or transferability, assignability, SRTs, those kind of vehicles.
Thanks very much, Agustin. And Leah, for the next 6 months, what do you see in your crystal ball?
I think a lot of the things that we're seeing in the present market is what we're going to continue to see through the end of the year. So continued expansion and innovation in the intersection between fund finance and securitization. Our firms worked on a number of transactions that are really innovative as we work together with our capital markets colleagues to craft solutions for, fund sponsors that are looking for interesting liquidity access. I would say that we're seeing it both in terms of cash securitization as well as synthetic structures like CRT. NAV is going to remain hot. Our team has just never been busier in terms of that product, and I think that that's not going to change as this year goes on. As it relates to sublines, I think we're going to continue to see more sublines convert to hybrids. As funds get longer along in their life, they have less uncalled capital, but they can look to their assets for liquidity and remain basically in the same deal, just essentially amending it. We're going to see more tranche Bs and term loans to also give more runway in these existing papers. Sometimes a fund is going to think about whether to add a NAV deal separate for its subline, but sometimes it can be a more efficient use of resources to just convert the existing subline to access new pockets of liquidity with those other elements. I think we're going to see additional use or continued use of insurance products, combination of credit loss insurance, as well as things like financial guarantees. And while we have seen those in sublines, I think we're going to see them coming into NAV and other types of deals, even maybe CRT. We're going to continue to see insurance as an investor in fund finance in a number of ways. We're going to see them coming into CFOs and rated note feeders and on the one hand, but we're also going to see them as NAV lenders. And we obviously, that's a big part of our firm's practice. We're going to see credit ratings as a continued feature, giving that element and other elements. Lengthening tenors, going back to getting more, more use out of your subline. I think fundamentally we are seeing lengthening tenors coming off of that really short tenor that we were seeing in 2023. It used to be, 1 month SOFR for 364 days. And now we're seeing, this lengthening tenor that is coming in term sheets, and also you have the term loan element that's going to even potentially be longer than the revolver. We have high net worth coming in. So evergreen funds, we're going to see evergreen funds in sublines. We're going to see evergreen funds in NAV. And then we're going to see concentrated NAV. We're going to see facilities, and we're already seeing them. And I think we'll continue to see them where a fund will do a NAV deal where it has less than 5 assets. Maybe it has 3 or 4 assets. And then we're also going to see financings to continuation vehicles, which may only have a single asset. And then the last item I would say is, GP and Manco lines. I would say in the last 24 months, we were not seeing a ton of those. And in the last year, we've seen, and even in the last 6 months, we've seen a pickup in activity of not only providers of that product doing more, but bank lenders that were not previously providing that product as a way to deepen and expand the relationship with the existing sponsors that they already have NAV, hybrid, or sublines with.
Thanks very much, Leah. And Russell, from your side, what do you see?
Yeah, so I think I think I agree with everything Leah's saying there, and it's interesting to maybe contemplate. Those are the reactions. So that's the reaction, and we're sort of we're trying to look through that. If I sort of wear my credit hat for a change, that actually it all stems from the slowdown in realizations, and which is impacting on fundraising. And then if we look across the market, I'm beginning to see that there used to be absolutely, no problem with fundraising if you were a mega manager. Like there was a sort of flight to quality, and your mega funds had no problem securing 6 billion, 8 billion closes, but your mid-market managers have been struggling for the last 24 months plus. Now, there's just that little creep in now where I'm hearing some of the larger managers begin to say they're feeling the pinch on being able to fundraise based on that trickle-down effect of slowdown in distributions and asset realizations. So I think that's kind of a general trend. And then there's a kind of so what question, and how does that change GP behavior? So GPs are looking to kind of for more bang for their buck, and we're seeing a little bit of a kind of move down the risk curve on GPs. So they're looking for higher yielding assets that will add slightly more punch to differentiate the performance of their fund from those of their peers. So there is a little bit of a kind of, I guess, a degree of caution about is this environment going to change the way that GPs, invest their funds within their investment policies. And that sort of stems from a macroeconomic level of uncertainty. And I guess, without being too doom and gloom, is there some positive stuff we can take out of this? And one of them, I think, for Europe, and there's potentially a larger European audience here for you, Michael, but there is what we are terming kind of de-dollarization. A lot of GPs and a lot of facilities at the moment are struggling with things like Section 899 in terms of the tax implications, and beginning to just think about, what does that mean if you've got a portfolio of US assets that you're looking to realize, and you are a European or APAC based fund? Not so much of an issue if you're 4 or 5 years from realization, because you might take a view on the political outturn at the next election. But if you're looking to realize assets in the near term, that's going to be a headache, and that's in your 6-month window. So I think to sort of on top of the reaction, and I think Leah touched on that, as ratings, increasing non-bank lender participations, NAV and hybrids, they are the reaction to what is happening kind of to influence that investment activity, I suspect.
Thank you very much, Russell. And to the audience, do not hesitate to send questions. There is a question button. You can send your question during the event, and we'll take them up progressively. So I take one question for you, Russell. So aligning to Russell's point, referring GP transparency, where panel is seeing subline against recallable distribution, are lenders asking more questions about GP's intention to call and testing that repayment does come from those recallable, or are these always hybrid deals rather than sublines?
Okay. So recallable capital and its proportion of recourse is variable. A lot of that depends upon how well your sponsor. And for us, and I'm going to be extremely kind of honest here, it is about the increased dispute risk on recallable capital, particularly as we head into times when we are seeing more assets struggle. So latter in a fund's life, is the recallable reliance on recallable capital does beg the question about, has that LP base already seen a good return on their investment, and are they slightly less inclined to want to meet recallable capital obligations in the very late stages of a fund? So I think it's always a case by case, and a lot of it is probably less sensitive on recallable capital during the investment life of the fund. So if I'm saying during the deployment period, if you have a very quick asset churn and that capital is recallable, I would be definitely far more relaxed about including that. If you are in the down to the last 2 or 3 assets and you're wanting to rely on recallable, I think there's definitely a degree more sensitivity. So it's probably a bit of a political answer, but I think there's those are the two the two dichotomies of where recallable capital is less or more more difficult to come to terms with.
Thank you very much, Russell. And now it's time to tackle the specific topic of the day, so due diligence. So the first question for you, Russell. So what are the due diligence requirements for alternative lender where they want to participate to existing facilities?
Okay, yeah. So this comes down to what we're talking about around expectations on GPs to be more transparent. And I think Agustin mentioned it that we're all very lucky in that the private market and private capital growth continues to drive this sort of insatiable demand for fund finance as a product. We are seeing effectively bank capacity somewhat constrained. There is an inability for banks to meet those future needs, and then the emergence of non-bank lenders means that we as lenders are beginning to act more like arrangers and facilitators of these facilities, bringing behind us multiple solutions, be it SRTs, securitization, non-bank lender participations. And as part of that we are having to have sort of those increased due diligence asks on the ability to share that material. And there are sort of, two different camps. There are lending partnerships where the banks remain lender of record, and those alternative lenders are willing to place reliance on the lenders themselves to originate, and then the participations happen obviously through to the SRT type structures behind the scenes. Then there are the other camp, which is non-lenders who act more like lenders and need full transparency across the facility, the LPAs, and the legal due diligence. And that is where we're having to sort of coax GPs into understanding that to access or to continue to have access to deep pools of liquidity, they will have to accept that some of that information, which is quite rightly closely guarded, will potentially have to be shared with those alternative lenders and rating agencies just to facilitate the future needs of those particular sponsors in terms of demand for continuing borrowing.
Thank you very much, Russell. And Leah, can you maybe tell us about the due requirement for rating agencies and insurance companies?
Sure. I would say that ratings agencies and insurance companies take a really deep dive into the facilities. Many times the facility is already in place, and they are looking to understand a lot of fundamental elements of the deal as they relate to repayment of the facility and sort of the worst case scenario. Oftentimes I find that the work, we work with ratings agencies and insurance providers, And I find that the work product that we put together is, very similar to what a syndicate lender would care about, but it's a much deeper dive into the facility than a syndicate lender is usually going to have. A syndicate lender is usually going to take a lot of comfort on who the agent is and that the agent has good counsel. And they will look at what they need to understand, from their credit perspective and other elements of their calculus. But the insurance and the ratings agencies are really looking deep. So they're looking at the underlying transaction, of course, and that it's papered correctly. But more fundamentally, what they're looking at is the underlying questions about the fund borrower. So if you're talking about rating a subline, that they're looking at who the actual LPs are, and they're making sure that everything is papered correctly. They're thinking about, does the collateral package work? Is it perfected? Do they have legal opinions on everything? And ratings agencies will also look at that as well, because it's really a similar, very, very deep dive into the transaction. I mean, it's been really interesting as we're talking about, we've seen a lot in the news about, ratings agencies coming out and how they're rating capital call securitization, for example. And there is so much focus at the end of the day. Obviously, different agencies have different criteria and how they come about their rating. But really, at the end of the day, it seems from where I sit that there is a lot of focus at the end of the day at the underlying wherewithal and willingness of LPs to fund, and those underlying documents really working.
Thank you, Leah. And Agustin, can you tell us more about the interaction between the lenders and these agencies?
I mean, we have a regular touch base with them, with the usual suspects. And at least in our experience, what we have analyzed is that they have a really, really similar way to analyze subscription lines and IB facilities as the one we have with our credit risk. So obviously, they are going to pay attention to the asset manager, the track record, which vintage is the fund we are analyzing. They are going to pay attention to the security package, if there is a notification, the domicile of the fund, to which legislation is subject or governing law is subject the facility agreement. They are going to pay attention if there is overcall limitations, who are the LPs, what is the percentage of high net worth institution or the institutional investors, what are the leverage which in the fund can incur according to the LPA, what is the track record of the previous vintages of this particular fund or the asset manager. So our way is that more or less, and each of them has a different, I would say, internal model. But summarizing, what we see is a blend between 40-50% asset manager track record, and the rest is going to be how strong is the security package, the governing law, and the diversification of the LPs.
Thank you, Agustin. And Russell, can you add something?
Yeah, I mean, I think we've covered most of that, but maybe the topic of most contention is who instigates a rating and who pays for it, because there are various regulators, regulatory views on solicitation of ratings, and how they had gone about, and actually the rating agencies themselves are. And I hope there's not too many of them on this seminar, but they're actually quite defensive of being open about this, because the more they keep this behind closed doors and the more they keep a small circle of lenders who are individually paying for ratings and annual maintenance of those, the more they enjoy a gravy train. And actually the most efficient way would be for GPs to engage and rate their facilities and then split that cost with those investors and or lenders who wanted to participate and see that rating. So there's just an interesting dynamic, and we have seen a few GPs take that approach, but we also see the majority of ratings are produced private side for lenders, as Agustin says, who have standardized RWA considerations. So actually, it's not a due diligence point, but it's maybe I'll get back off my soapbox and say that potentially it's for GPs to embrace the rating side of it if there's a need for that liquidity.
Thank you very much, Russell. Now you can give a few more words about the LPA and the due diligence about the LPA. But first, we can take a step back some years ago. So I would say that in the 2010s or the early 2010s, generally to close a subline, you would have an investor letters. It means that it's a document from the investor where actually you will have wherever defenses and counterclaims. It means that the investor will commit to pay directly to the bank without any discussion and raising defenses. And also they will give some undertaking, such as paying on the specific accounts and so on. And actually the market moved because at some point it was difficult to obtain investor letters, and that yes, the GP would come to us and say, okay, we cannot obtain this type of letters, so we need to find solution to close. And then in Luxembourg, you need to find solution at the time on the market. And I remember discussion that I had with the team at the law firm what I was working before to say, okay, we can find solution, but let's have a look at what we have on our toolbox, in the legal toolbox. So in the Luxembourg legal toolbox, there are, I would say, two different specific concepts that can be used. So the first is in the Luxembourg financial collateral law, you have a provision stating that indeed the debtor of a claim, which is pledged, can waive defense and counterclaims, as well as right of set-off, and it is valid vis-à-vis third parties. So this was a first tool. That's okay, we can use that tool. A second tool is that you have a stipulation for third parties. It means that two parties may agree to grant rights to another party. So the idea was for the investor to grant undertaking for the benefits of the lender, so such as paying the money on a specific account. So now the idea is to, yes, how to formalize it, because you have no investor letter. So with the discussion that we have before, what I propose is to, okay, if you have a contract, then an LPA, you can put this provision in the LPA. So it means that you will have the waiver of defense in the LPA and all those undertaking for the lender. And since then, the market has moved, and we have indeed in the LPAs directly the specific fund finance provision, so that we don't need any investor letters and so on. And the other point is where you have not LPA, because from some funds which are not partnership, so are more companies or corporation, then you can put this provision in the subscription agreement, because this is again a contractual document provided by the investor. So Cam, from your side as borrower counsel, so what are the typical provisions that you want to see in LPA before seeking a fund finance solution?
Well, the provisions that I'm looking for are the ones that Russell, Agustin, and Leah want to see effectively. I'm trying to sort of make sure that when the LPA goes across to lenders and lender counsel, that the relevant provisions have all been included. I mean, in an ideal world, I'd like Leah to be able to check off her checklist and sort of tick every single point that she needs to see. And so that's obviously something we're very focused on. And I think that, I've always been very focused on ensuring that I work closely with our funds formation colleagues and also our fund manager clients directly, so that they're not just drafting these LPAs, sending them to investors, finalizing them without having a fund finance person actually take a look at the relevant borrowing provisions. And I think that, Agustin made the point that sometimes you haven't had LPAs that don't even have a power to borrow. And so there are some fundamental points that really need to be addressed. That being said, I do want to reiterate the point I sort of made at the start that, sometimes we are treading that sort of fine line between, what would be perfect and what the investors will sort of be comfortable seeing, particularly if it results in a red line between the previous fund LPA. We don't always get free rein to sort of include everything that we think would be perfect. That being said, obviously the power to borrow is very important, and not just the power to borrow sublines, but if the fund is considering NAV facilities, the power to sort of do that as well, and then also the sort of the consideration of like what sort of limits should apply to those borrowing powers, and is that appropriate for what the fund is actually seeking to do when it enters into these types of facilities. So you obviously have those sort of key points that are absolutely essential, but then there's also some things that aren't necessarily going to make the deal fall over without them, but they are going to make the lender's analysis of the situation potentially more difficult. And so, where we see things like limits on the ability to overcall from investors, it won't necessarily mean that the deal can't be done, but it might limit the fund manager's ability to borrow. It might make it more difficult for certain lenders to get comfortable. And so really ensuring that we can maximize flexibility for all potential lenders who might look at this, at lending to this particular fund manager, to ensure that we sort of try to build that in is I think, also key. But that is one of the areas where sometimes it doesn't always work out the way we would sort of like in an ideal world. And then, Michael, I mean, your point about the sort of things like the investor provisions that were previously in investor letters, more and more, obviously, we see the focus from lenders on having those, particularly that waiver of set-off counterclaim defense. And so that is one area where we do see some of the older LPAs not sort of containing all the technology we would expect to see in a more modern LPA, and really trying to sort of emphasize to our fund manager clients that this is actually essential. It's not just a sort of nice to have provision. So I think those are just sort of a flavor for the things we're looking at. And all else I would say to sort of close out is that it's not just the LPA where our sort of work stops. We obviously have to consider what the side letters say, because we don't want all of our good work in creating a perfect LPA to sort of be negatively impacted by separate things that are agreed in the side letters as well.
Thanks, Cam. And Leah, from your side, from a lender perspective, what do you want to see?
So echoing everything that Cam said here, absolutely 100%. And, it's interesting because, we've now moved into a world where an LPA has a subscription section, but we haven't yet moved into a world where there's like a NAV section. And so we do still get questions, particularly when we're talking to subline lenders that are considering offering a NAV or a hybrid transaction to an existing subline lender or borrower, is this authorized, and how much is authorized? And there aren't any particular NAV provisions yet. There's obviously been talk about adding that as a feature of a subline, an LPA, but you do have the ordinary debt provisions in the LPA that you'll look at. And other things that we're going to look for in addition to what Cam mentioned are, what are the remedies for investor defaults? Can you incur debt after the investment period? The right to call capital to repay debt after the investment period. Any withdrawal or excuse rights that we need to be mindful of, because those will factor into, the credit agreement in terms of, exclusion events and other features. Are the lenders third-party beneficiaries under the LPA? Is there a key person event, concept in the LPA, and what is the consequence of that occurring? Recallable capital, and that's really interesting because, everyone's talked about how different vintages of LPAs may stay the same, but actually I would say that is a feature where different vintages of LPAs will vary greatly, particularly since there's I don't know if it's a greater flexibility for those changes, or maybe because it potentially gives the fund additional flexibility to operate things. And I think it also gives additional potentially access to liquidity for borrowed money. But that's something that really can vary fund vintage to fund vintage. And leverage limitation limits and how the fund would go about changing them. And then obviously an MFN is also something that we're going to look at.
Thanks very much, Leah. And about due diligence for NAV regarding credit funds, can you tell us a bit more about that, Leah?
Sure. Really paramount when you're looking at that is understanding the assets and how the assets are held. There's a lot of different structures that we'll see for a credit fund, and sometimes it's really interesting. I think some of the most interesting conversations I have with lenders about the collateral package and the structure of the deal have to do with credit funds. I think there'll be sometimes an impression that the assets are held in different places and really they're kind of all in, maybe with a custodian. And so I think doing a really deep dive to understand precisely what the assets of the fund are, how and where they're held, and sort of the status of those investments is really critical at the beginning of a deal. It's going to formulate your collateral package. It's going to formulate maybe cash sweep mechanics. It's going to probably play into amortization. But it's super interesting because I had a deal about a year ago where the bank came and said, like, this is going to be a really, really hard one, and this is going to just take a really long time. And it turned out there was like a very simple and streamlined way that the assets were held, and it was very, very straightforward. And we sometimes have the opposite as well. So I think just fundamentally understanding the structure is really key.
Thank you very much, Leah. And Russell, from your side.
Yeah, well, I think I'd agree with that, and maybe Leah's observation is one that's akin to the worst people to do due diligence on a credit fund is a bank, because they think that they're better at doing it than the credit fund. So there's a little bit of like, well, I'm sure their credit process is not as robust as ours, and I'm sure that that there's a degree that we can pick apart their whole process. So I think it's so GPs looking at this and going, why do I get such a hard time on my credit fund due diligence is because you're looking at a sort of an institution that has sort of hundreds of years of lending background, habits, policies, etc., and they are looking at you as a GP and how you are effectively managing your asset origination. And then so that's one, just to be aware of the context, and I think Leah picked up on it, that the principal DD point for us as lenders is around those assets, and really what qualifies. So the cornerstone of any NAV line is going to be an LTV covenant, and the cornerstone of an LTV is the V, and the V is how what are those assets, maintaining that level of portfolio diversification, so concentration limits. What assets are qualifying? How do assets fall in and out of the pool of qualifying assets? Because obviously, as a lender, you don't want to be sat against a portfolio of poor performing assets that increases your risk rating and turns your capital, the capital that you're holding, up, and therefore reduces the return to the shareholders that we are effectively bound by. So don't be surprised to see a lot of questions there around your credit process, underwriting, your collection process, and then a lot of scrutiny around what counts to the V and the LTV.
Thank you very much, Russell. And Leah, can you give us some more about the due diligence process for NAV for PE fund now?
I think a lot of questions goes into how the assets are held, what the structure looks like, how are the financials put together, what kind of rolls up to what and what's consolidated into what, how many assets are there, and what is the plan for disposing of assets or acquiring assets. I think it's really just the fundamentals of, when you're talking about, like BioNav, for example, like just how does it all work? because those are going to be things that are going to impact your covenants, particularly your financial covenants, your reporting, and all of these deals. I mean, something, we talk about the commoditization of sublines, which isn't real actually at the end of the day. But I would say decidedly NAV is not commoditized. And what makes it both challenging and exciting for the lawyers is that you have to learn the structure and really craft this bespoke facility document for each and every deal. And maybe you'll have a vintage that will have a similar fund structure where you can utilize precedent kind of going forward. But each of these funds is going to be unique in terms of the assets it holds, what jurisdictions they're located in, what kind of jurisdiction of the entity that holds them, how does it kind of like roll up and everything else. So I think that bespoke nature means you really have to do a deep dive and truly understand the ownership as well as the flow of money through the structure.
Thanks very much, Leah. And Cam, have you something to add on this?
Yeah, I mean, the only thing that I would really add is, particularly if we're talking about secured deals, so where there are share pledges over the sort of shares in the topcos, really understanding the sort of constitutional documents of the topcos and particularly any shareholders agreements. I mean, it's a lot easier if these are all sort of 100% held by the fund, but in most cases there is some sort of minority management shares issued, and understanding what rights attached to those shares, in particular things around the requirement to consent to pledges, but also sort of more commercial terms like tag and drag rights, things that might impact an enforcement process. I think those are really important to understand, because it really does affect, particularly if the lender is expecting to take security, how you would structure that package. And we've seen some deals where perhaps relations with the minority shareholders aren't as perfect as they otherwise might be, and there's no sort of real desire to ask them for that consent, and we've had to construct packages which might mean that 8 of the 9 assets are pledged, but one of them is kept outside the sort of security net because of those sorts of types of consent requirements or other considerations. And so I think the sort of diligencing those, and from a borrower perspective, ensuring that we're sort of highlighting those issues earlier on in the process, particularly during structuring, I think is really important.
Thanks very much. And Agustin, from your side, have something to add?
On our side, we put a lot of attention and effort to the external valuation. There are some times in which we need to rely on the underlying GP valuations, and we are not comfortable with that. And this is always sometimes a deal breaker. But in every new NAV that we enter, we require a third party, a reputable one, issuing at least once a year an external and independent valuation. This is one. And also, even if we are stating the obvious, we pay a lot of attention to the look-through LTV, because there are some times, for instance, in which you are providing an NIV facility to an infra fund, and maybe you are at a 15% advance rate, but you realize that the underlying assets are already leveraged at 80-85%. So no much buffer to play if there is whatever movement in the market, and you get killed. Even if you were thinking with your this department that you were lending at a really, really conservative loan to value. And this is not a hypothetically situation we have seen, for instance, in Spain with the renewable asset, in which suddenly the government has issued a new rule, and right now there is another scheme in order to pay the equity or repay the equity, and what it was at 75% leverage, suddenly with the new regulator is at the 90%. So all the NIVs which had previously somehow structured with a 30-40% advance rate, they are struggling. And this is a lesson we have learned from the past.
I think the valuation piece is also really interesting as a lender is looking at how to interface with a fund, because there's definitely a continuum of like what is market in terms of how valuation works. Like, are you going to be really deferential to the fund and its valuation policy? does this particular bank have a desk where they know this asset better than the fund might? Or is this a fund where you think the valuation policy might be aggressive and maybe you want to have more parameters on, call it intra-quarter fluctuations or something like that, where you would have a little more guardrails on to get a real sense of the valuation? And it's really interesting to have conversations where there's a diligence to like how it's done, but then the bank has to make a decision of like the deal it wants to cut, and all of that sort of within the market of how it's done.
Thank you very much, Leah. And more specifically, we're getting Sublime, so we tackled it a little already. But can you give us a few words about the diligence for Sublime?
For me? Yeah, sure. In addition to the LPA, we're going to look at every investor letter. Fundamentally speaking, an investor letter is an amendment to the LPA that applies to a certain investor. And so you want to understand what those investor letters say, what those side letters say, and you want to understand precisely how they will impact the rights that the lender has as it relates to that investor. And, there's particular significance to that because often the strongest investors with the biggest commitments are going to be the ones that have these side letters. And then you could have an MFN process where other investors can opt into certain provisions that other investors have. So understanding that as well is really key. And we do a deep dive into all of them. And some side letter provisions we can address in the credit agreement. Sometimes you might do an investor letter to address them. It kind of depends on what you're dealing with. We also look at every single subscription agreement that every single investor signs. And we are looking at the end of the day to make sure that the fund itself has an enforceable contract with its own investor, because the right to call for and collect capital calls is what's being pledged to the lender. So it's something where, while we may have some back and forth with the fund, we really think that the lender and the fund are totally aligned in having this be right. So you're going to look to make sure that, it's that there's a GP acceptance that's, sort of dated after the offer from the investor, kind of like those really fundamental principles of contracts that the lawyers among us remember from, contracts law. We're going to make sure that everything works here. And then likewise, part of understanding all of that and understanding the fund structure itself and looking at every single LPA for every element of the entire fund structure, where you're talking about who's an obligor, we're going to look at, are certain investors coming in with debt commitments, and how are we going to grapple with that? What are the terms of those debt commitments? So we are really going to shake down the entirety of the fund structure and the documents that support it to really fundamentally understand the fund and its business for the purpose of, crafting the subline.
Thank you, Leah. And Cam, from your perspective, what can you add?
Not a huge amount more, except that, typically we are being requested by lenders and lender counsel to supply the sorts of agreements that relate to the management of the fund, the administration of the fund, things that might provide for the delegation of powers to issue capital call notices. I think that lenders are very keen to understand, whether those rights have been delegated, because it may impact the way that they put together the security package for the particular financing.
Thank you, Ken. And Agustin, from a lender perspective, what can you add on due diligence for Sublime?
Well, the standard one. Sorry, because I was responding to one question. It was on the chat. I was starting with it. It was J2. Yes, for you, J2, you have your response in the chat for you to know. Straightforward. We see, obviously, the track record of the asset manager. We see what are the overcall provisions. We see the ability to grant pledge over the uncalled commitment, the notification. We see the diversification of the LPs. We see if they are able to include new LPs. If those LPs are investment grade, are automatically eligible for the, I would say, for the borrowing base or for the investor cover ratio. If not, we need to check internally. You open a debate that if not, it's going to be subject to the majority of the lenders, or it's going to be subject to unanimity. I mean, assess the maximum leverage that the fund can incur. What are the permitted rotation strategies? We can share information either with a rating agency, either with a private credit insurance company. If we can sell in secondary, if we can share information with potential other banks if we want to scale back. I mean, the typical stuff.
Thank you, Agustin. And Russell, from your side, what can you add?
Yeah, so well, I think we've covered a lot of the due diligence, but I'll maybe take the opportunity to answer one of the questions in the chat from Hannah. So the question, if you can't see it, is have you seen many finances with open-ended funds? If so, what are the challenges, and how did you combat these challenges? So it's a great question, and particularly relevant to this kind of due diligence discussion, because I think what you'd have to be prepared for, Hannah, is to do twice as much work. Your due diligence encaptures everything that we talked about in terms of your subline due diligence, because you are, ultimately in an open-ended structure. You're either looking down at the NAV or up at the investors, and a combination of both. But you can't afford to leave any stone unturned in either direction. So I would say, you need a very good counsel. You need to have a strong stomach for the time and complexity that these structures will undoubtedly take to put in place. They are not insurmountable, but I would also say that they need to have a degree of flexibility and longevity. That the whole point around open-ended funds is that they should be sort of effectively a more permanent level of investment, or a longer-term horizon, and that's the same approach I would take to put in place a facility for one of those types of vehicles, because it's a long journey. So that's a relatively simple answer, but hopefully helps you, Hannah.
Thank you very much, Russell. And now I think that we come to the end of the program. So I want to thank you again to all the speakers for your time and all these insights. And thank you as well to you all in the audience. And see you soon for our next Fund Finance series. Bye-bye. Cheers.
Thanks, Michael.
Thank you.
Bye.
Nice to meet you all.
Bye.
Thank you.